Good Saturday afternoon. I am coming to you live, recording at least, just ahead of the Knicks versus the Miami Heat tip-off. So going to try and make this quick. But I hope everybody's having a great weekend. Again, my name is Seth Golden, and this is Finom Group. This week's video will kind of pick up where we left off last week, discussing the NASDAQ and the NASDAQ breadth. If you're not familiar with my last video, check it out at Finom Group's YouTube channel. NASDAQ is about to collapse, or is it? Where we discussed a lot of the different nuances within the NASDAQ's performance this year related to breadth and the advanced decline line, so on and so forth. So with that said, I figured, well, we've already talked about the NASDAQ. Let's jump into the S&P 500 and look at it from a breadth perspective, or at least, overall performance. So this is my chart study of the week, which I formally talked about in our weekly State of the Market at Finom Group. And by the way, if you like this kind of analysis, in-depth studies, quantitative data, fundamental data, technical analysis, won't you consider joining us at Finom Group? Every week we put out a weekly macro market research report with using three disciplines: fundamentals, technicals, and quantitative analysis. It's jammed packed, folks. It will get you done so far as, what should I do? What kind of environment is this market? What kind of macro backdrop do we have? What does it look like going forward? To get our macro research report every Sunday morning and our state of the market video each Thursday, you can simply subscribe to our contributor membership at $14.99. If you want an interesting trade and invest with Finom Group using our time-tested trade alerts and investing ideas, you can upgrade to our premium membership for $59.99. You get everything else, plus you get our investing and trading ideas. All right, with that said, again, our chart study of the week. You've probably heard it to death at this point in the bear market recovery cycle. Breadth is getting weaker and weaker while price remains relatively strong. I concede that is a fact, but is it normal or even useful for the average investor? Today, we are hearing a great deal about how equal weight S&P 500, ticker symbol RSP, is materially underperforming the cap weight S&P 500 index ETF, otherwise known as the SPDR. Again, this is true, but is it normal or even useful for the average investor? In the context of a bear market recovery, I'll aim to discover the answers. Please note that in order to do so, we look back at previous bear market recovery cycles, but recognizing that history does not always repeat. And we should remain flexible and open to a wide variety of outcomes, regardless of how compelling the evidence may prove. And folks, I'm about to deliver some compelling evidence that what we're experiencing here by way of the equal weight S&P 500's performance relative to the cap weighted S&P 500's performance is normal, to be expected, and almost textbook perfect. All right, so I'm going to blow up the chart here, give you a better look. What I have in the top chart, right, this is a stack chart, same thing, RSP versus the SPDR. So that's equal weight versus cap weight. Two charts are identical. They look identical, don't they? So far as my markings on the chart, right? And I'm going to explain why it looks that way. So in the top you have, and most of you remember this time period, if you've been investing since the Great Financial Crisis, this was the Great Financial Crisis low of March 2009. RSP versus SPY, equal weight relative to the cap-weighted S&P 500 index ETFs. When the trend line is moving up, that means equal weight is outperforming cap weight. Trend line's moving up, folks, off of that March 2009 bottom. Right? And that gives you kind of this understanding that it's a true market bottom. Everything is rallying off that bottom. But more importantly, history does teach us that equal weight tends to outperform cap-weighted S&P 500 off of market lows, which it did in 2009. If we scan across the chart, March 2009 to March 2010, that's 12 months, still uptrending, right? March 2011, that's 24 months, still in an uptrend, right? Equal weight still outperforming cap weight. 24 months, 25 months, 26 months, 27 months, 28 months. It wasn't until the 28 month that we pretty much peaked out and started to roll over, breaking the long-term trend line. And here we were in late 2011 going into 2012. So you had a perfect 28 months worth of outperformance. And it started at the March 2009 low, signaling possibly, in what turned out to be reality, the bear market low and the beginnings of a new secular bull market. Fast forward to the most recent, well, I can't say the most recent bear market, but the most compelling of bear markets, the COVID bear market bottom. Now, that was the bottom in March of 2010 for the same performance ratio, but the bottom in the performance ratio didn't happen until September. So that's our starting point for this particular study from the COVID low or the COVID regime in 2020. The bottom was in September of 2020. So we go to September of 2021, that's 12 months. And we go to September of 2022, that's 24 months. And we go to the peak is 28 months, right? So from bottom to bottom, I'm sorry, I should say trough to peak, 28 months. From the trough, COVID trough to peak, 28 months. Break the trend line, and here we are. Break the trend line, and here we are. You can't make this stuff up, folks. Like, for all of the consternation and all of the worriment about market breadth, Willie Delwich this week, continue to see more new lows than new highs, currently in the longest continuous stretch since November. Calling this a new bull market, is fighting the tape. This is a different way of measuring breadth, using new highs versus new lows. I get it. We covered that last week as well. But in terms of the current cycle, right, if what you have going on right now are fewer stocks are keeping pace with the S&P 500. Hence, most stocks, the average stock or the equal weighted S&P 500, the average stock is not keeping pace with the S&P 500. I'm starting to believe that people are just pissed off because they're still trying to be stock pickers like last year. Remember last year, and the average stock was beating the S&P 500. The S&P was down 20 and 25% on a closing basis at the lows, but the average stock was doing far better than that. Equal weight was still uptrending compared to the S&P 500. You flip that around this year and everybody's going to say something bad about the market. Why? Because their stock picks are doing poorly. Here's kind of a demonstration of that. This is the S&P 500 last year. Can you see why so many are so bearish and mad? 2022 was indeed a stock picker's market. It had the highest percent of individual stocks outperforming the S&P 500 since 2013. More stocks were outperforming the S&P 500 last year than they are this year. This year, we have the fewest percentage of stocks. 2023 Q1, fewest percentage of stocks beating the S&P 500 since 2007. Starting to think this is not so much about breadth and more about people just being upset that they didn't stick to the plan, which is just, if you're going to do bad over time, if you're trying to be, I shouldn't say you're going to do bad, you're probably not going to do as well as you'd like to if the majority of your portfolio is stock picking. the index ETFs will get you done if at least you're going to market perform. Remarkable, folks. 28 months, tops out, and starts to decline from the great financial crisis, from the COVID lows. Equal weight outperformed for 28 months relative to the S&P 500, peaked out, rolled over below the trend line. We've done this before. There's nothing strange going on here, folks. It's not voodoo. I also wanted to see, right, because people say, yeah, but bank failures. You don't think there were bank failures after the great financial crisis? In 2009, in 2010, in 2011, in 2013, in 2016. Folks, there were tons of bank failures. 2009, 10, 2009, 2010, 10, 13, 11, 2011, right? And 2011, our top chart, that's when things went badly for the equal weight. 2011 tops out and rolls over. The cap weighted index did far better than the average stock. So you can't say, well, yeah, but wait, because now we have bank failures. We had bank failures after the great financial crisis too. Were they as large as they are today? No. No, of course not. But the household balance sheet wasn't as strong either. They didn't have excess savings back then. The corporate balance sheets weren't as robust. I mean, we can what if this to death, and we can put our own, little spin on things till we're blue in the face. Price knows. Price is truth, folks. What else was happening after, 2000? Well, from here's 2011. I want to look at yields, right? I want to look at yields. What were yields doing in 2011 when the equal weighted S&P 500 crapped out? From the first trading day of 2011 to the last trading day of 2011. Same thing they're doing now, folks. Same thing. Yields topped out, rolled over, and just kept falling. And that's what's happening today. Right? Well, the indexes are cap weighted, right? The biggest stocks are tech, Microsoft and Apple, right? They're usually sensitive to both higher interest rates. They're more responsive to higher or extremely high interest rates for a particular regime. And when those interest rates roll over, they're just as responsive. It happened then. It's happening now. We have very similar circumstances. We shouldn't be surprised. You shouldn't be concerned that there's something on the horizon. There's something ominous. The economy's not showing that. It's not what we're seeing in the economy. Do you think auto sales would be this strong in April? Look at that. Credit crunch, I was told. Look at auto sales. That's your credit crunch? Heavy duty truck sales jumped 23%. Are you kidding me? Credit crunch? Look at the consumer. Now, you could make the argument back in March, we had some poor spending on retail and food service. This is payment card transactions from the Bureau of Economic Analysis. You can see this updated every week. But look what has happened off those lows. It surged like 13% in the 4 weeks through April. Credit crunch, consumer fears, it's not showing up. Yesterday, Friday, we had a pretty strong bounce back, right, folks? We were down 4 days in a row in the S&P 500, and then all of a sudden we gained 1.85% in 1 day on the S&P 500. Shouldn't be any surprise. That's been the trend all this year. We take the escalator down and the elevator up. That's what's been happening this year. It's kind of a role reversal. It's the strongest by the dip response to dips that we've seen in decades, if ever. Market doesn't want to stay down, let alone go down. But when it does, investors are buying the dip. Listen to markets. Listen to markets, folks. I don't think the bulls are fighting the tape here. I think folks just don't like that their individual stock picks aren't working to the extent that the indexes are this year. With that being said, on Friday, JP Morgan's Global Composite Output Index was released. May 5th, JP Morgan Global Composite. I'm getting ready for the Knicks game, folks. And yes, it's the Knicks game. It's not the Miami Heat game. I know where I live in Florida, but it's the Knicks game. Born in New York, Brooklyn, 1976. I did come down here when I was 2 years old. The weather was too cold for me up there. Either that or, yeah, you're 2 years old and you go where your parents go, right? But anyways, with that, this was released on Friday, Cinco de Mayo, for those of you who celebrate. And it's the global economic growth gathers momentum at the start of Q2. This is the global composite output index at a 16-month high. Tell me about your recession, folks. Tell me about it. Oh, jobs are a lagging indicator? You've been saying that for 15 months now. At some point, you have to realize it's not an indicator, period. We have strong growth. We have a strong global economy right now that is only strengthening. The market's rise on Friday was not an accident. Institutions get this data, and they know what to do with it when they see this kind of an inflection in the JP Morgan Global Composite Output Index. I read everything. I read it. That's why people don't like me. I get it. All right, let's move on here. The Fed is tightening. The Fed is tightening. I think this is my last chart of the week, and then everybody can go enjoy the game. Here's the funny thing, or I think this is a little bit comical. Our top chart here, cash on consumer balance sheets has started falling, but so far only gradually. Look where cash on the balance sheets of the consumer, i.e. households, was in the pre-pandemic period. Look at where it is now. The Fed's tightening. Remember this. The Fed's tightening because look at the bottom chart. Remember the bank failures, right? The deposits are leaving. They're going into money market funds. Estimated inflation-adjusted monthly income from money market funds. Right? Look at this skyrocketing, folks. That's all that extra yield. That's all that extra, percent that gets tacked on to your money market fund. That's what the average household's getting now. No more of that savings account with less than 1% interest earned. No, they're going into money market funds and they're getting this huge percentage on the money that's parked there, which is only exacerbating how high the consumer balance sheet is stuffed with cash. It should be rolling over by now. It really isn't. The Fed is trying to fight inflation with these very blunt instruments that are only benefiting the average household because now they're getting better interest on their money that's parked with banks in money market funds. I mean, the Fed's damned if it does, it's damned if it doesn't, but certainly not hurting the average household. But that's all I have this weekend. Enjoy the game, folks. Go Knicks. They haven't won anything in a very long time. I like the Heat, but go Knicks.